Imagine watching the stock market stay calm while the real danger is brewing underground in the credit markets. That's exactly what happened in 2008, and it might be happening again. Before the global financial crisis, credit spreads were unusually tight. Investors were confident, chasing yield and ignoring risk. High-yield bonds, the riskiest corporate debt, were yielding just a couple percentage points more than treasuries. Everything seemed stable. Then the housing market cracked. Defaults spiked. Banks holding subprime assets started wobbling. Suddenly, nobody trusted anyone. And by the time Lehman Brothers collapsed, credit markets exploded. High-yield spreads surged past 2,000 basis points, over 20% above treasuries. This meant investors were demanding massive premiums just to hold junk bonds. Junk bonds are loans to companies that are risky and more likely to default. Because of that risk, they pay higher interest to attract investors. The bond market wasn't just nervous, it was screaming systemic collapse. While the equity markets were still trying to figure it out, credit spreads had already priced in chaos. That's the power of spreads. They move before the headlines. Now fast forward to today. We're seeing early tremors again. 6-month U.S. credit default swap spreads, the cost of insuring against a government default, just jumped from 65 to 70 basis points. That might sound small, but for U.S. sovereign debt, that's a serious warning. Investors are hedging what used to be unthinkable, the risk that even the U.S. could delay or default on its obligations. And it's not just government debt. A well-known investor made one of the boldest calls this year, going long on credit default swaps, also called CDS, betting on rising credit risks. His reasoning? Tariffs and policy uncertainty were eating into corporate revenues. Many companies have debt covenants tied not to interest rates, but to revenue and EBITDA. If sales drop, even slightly, those covenants break, and suddenly companies are in technical default even if they can still make interest payments. Let me explain how that works. A lot of companies borrow money with certain promises, called debt covenants. These are rules they must follow as part of the loan agreement. Some of these rules say you must keep your revenue or your profit above a certain level. It's like a deal. We'll lend you money, but only if your business keeps performing well. Now, here's the catch. Even if a company is still making its loan payments on time, if its sales or profits drop too much, maybe because of tariffs, a slowdown, or inflation, it breaks those rules. That's called a technical default. It's not that they ran out of cash, it's that they violated the terms of the loan. When that happens, lenders can panic, ask for early repayment, or refuse to lend more. And that's when things can spiral, even for companies that seem okay on the surface. That's the trigger for a credit event, and that's exactly what happened. Within 3 months, Chamath Palihapitiya's credit default swap trade delivered a 7x return. A $1 million hedge became a $7 million windfall. Not because the world ended, but because the cracks were already there, and the market started to notice. This is why macro strategists obsess over credit spreads. They're not just market trivia, they're early warning systems. High-yield spreads, investment-grade spreads, emerging market spreads, CDS, these are all gauges of stress, liquidity, and trust. In 2008, spreads blew out before stocks crashed. In 2020, they spiked again. But this time, the Fed stepped in fast, launching emergency programs and buying corporate bonds directly. That compressed spreads quickly, but only because the central bank acted like a backstop. So what happens if the Fed is late next time? Every time credit spreads widen, financial conditions tighten, borrowing gets more expensive, risk appetite fades, and the shockwaves hit everything: equities, real estate, commodities, even currencies. Right now, credit spreads are stirring again. Not at crisis levels yet, but if you're only watching the S&P or Bitcoin charts, you're missing the deeper pulse of the market. This is the story behind the story, and the bond market never lies. Follow the spreads. That's where the truth is. If you're here to understand what moves before the market moves, subscribe. This is where we decode the signals Wall Street doesn't want you to see.